not from a finance or economics background. Wondering how to quickly assess a stock before jumping into buy or sell? Join me as we walk through Max's stock trading journey and uncover how to quickly value a stock with multiples. Plus, learn about the other key factors you need to consider to get the full picture before making any investment decisions.
Minh, today is the worst day ever. I started investing in the stock market, and my stocks dropped like a runaway car down a hill with no brakes. To make things even worse, my girlfriend dumped me because she thinks I'm useless. Life sucks.
Whoa, slow down. It's not the end of the world. I didn't know you were investing. How long have you been at it?
I started last month. I'm a total rookie. I listened to a podcast, followed their advice, and now everything's crashing. What did I mess up?
You can't just follow a podcast blindly. You've got to do your own homework. Ever heard of the multiples method for valuing stocks?
No. Is it hard to understand?
Not at all, my friend. Let me break it down for you. Think of it like dating. Navigating the stock market is kind of like figuring out relationships. You want to invest, but how do you know when the timing is right? People always tell you buy low, sell high, but when is a stock really considered low? Is it at $50, $80? Well, the good news is that there's a way to get some clarity. In the stock world, we use something called multiples to figure out if a stock price is reasonable. It's kind of like checking out someone's dating profile before committing. You've probably Googled Apple or Tesla stock and seen all these numbers and terms pop up. One of the most important ones, the P/E ratio, which stands for price to earnings ratio. The P/E ratio tells you how much you're paying for every dollar of profit the company makes. It's like knowing how happy you are based on the lady you choose to date. You can figure out if you're getting undervalued or overvalued. There are two kinds of P/E ratios you should know about: trailing P/E and forward P/E. Trailing P/E is like feedback from your ex about how the relationship was in the past. It shows you what the company earned over the last year, helping you judge if the current price makes sense based on what it's already done. Meanwhile, forward P/E is like looking into the future of your next relationship, guessing how much you need to invest based on what you expect the company to make next year. Let's say you've been looking at Apple stock. If its trailing P/E is 34, it means you're paying $34 for every $1 the company earned last year. That might seem fine, but then you see Google's P/E is 23. Now, you're left wondering, am I paying too much for Apple? Like texting someone who barely replies while someone more interested is out there? Apple's P/E is higher than Google's. You might start thinking, this stock's getting a little pricey. But here's the catch. If you think Apple's going to keep growing like they've got a killer new iPhone lineup for launch, then maybe it's worth sticking around. If analysts expect Apple to grow and its forward P/E is 40, that's the stock market's version of a promising future date. Now, Max, let me warn you about the value trap, or as I like to call it, the stock market's version of getting back with a toxic ex. Sometimes, a stock with a low P/E looks like a steal, like getting a changed text from an ex. But you know better, right? Just because the stock looks cheap doesn't mean it's a good idea. A low P/E can sometimes mean the company's in trouble, just like an ex who's reaching out because they're lonely, not because they've turned into a better person. A low P/E might mean the company's profits are falling, which is why the stock price is low in the first place. It's a trap. Alright, so you've checked out the P/E ratio, compared it to its peers, and now you're thinking, should I invest? But hold up, don't rush. There are other things you should consider before you commit, just like in any relationship. First, revenue and earnings growth. Is this stock improving itself? It's like dating someone who's always learning and growing, a major green flag. Next, check their debt levels. Just like too much emotional baggage can weigh down a relationship, too much debt can drag down a company. If they're always borrowing money, they might end up drowning, and you don't want to be the one holding the life jacket. Also, look at their cash flow. This is like making sure someone can pay their bills. A company with solid cash flow means they can take care of themselves and you financially. No one wants to be stuck covering someone else's rent, or in this case, watching their investments sink. Don't forget about dividends. They're like little love notes, a company's way of saying, "Hey, thanks for sticking around." A steady dividend is a sign they're committed to rewarding you even when times are tough. And finally, check the management. It's like meeting their family and friends. You want to make sure the people running the company know what they're doing because that's going to affect their long-term potential. Strong leadership is key to lasting success. The P/E ratio is just one piece of the puzzle. You've got to consider the whole picture. Remember what Warren Buffett once said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." In other words, it's better to date someone amazing who values you, rather than settle for someone just because they're single. Do your research, be patient, and don't fall for something just because it seems too good to be true. And trust me, it'll get better.